Imagine you've spent 40 years climbing the mountain. You've worked the long shifts, dealt with the stress, and finally you've reached the peak, retirement. You're counting on that social security check to be your reward. But what if I told you there's a retirement ghost waiting to take a bite out of that check before it even hits your bank account? Most people think Social Security is tax-free, but for many, that's a myth that can derail your golden years. It feels unfair, doesn't it? You already paid taxes into the system your whole life. The thought of being taxed again on your own benefits can feel like the goalposts are being moved right as you're about to score. But here's the good news. Knowledge is your best defense. You don't have to be a math genius or a Wall Street pro to protect yourself. You just need to understand one simple concept that the IRS uses to decide if they get a cut of your check. That concept is called provisional income. Think of it as a financial thermometer the government uses to see if your retirement income is too hot or just right. To find your number, we use a simple three-part formula. First, take your adjusted gross income. That's basically your taxable income from things like a part-time job or traditional IRA withdrawals. Second, add in any tax-exempt interest you earned, like from municipal bonds. Finally, and this is the part that surprises everyone, you add in exactly 50% of your Social Security benefits. When you add those three together, you get your provisional income score. Now, let's look at the scoreboard to see what that number actually means for your wallet. If you are filing as a single person, if your score is $25,000 or less, take a deep breath. 0% of your Social Security is taxable. If you're between $25,000 and $34,000, up to 50% of your benefits could be subject to taxes. If you're over $34,000, up to 85% of your benefits are on the table for the IRS. If you are married filing jointly, the thresholds shift a bit higher. Under $32,000 means you're in the clear with zero taxes on those benefits. Between $32,000 and $44,000 triggers the tax on up to 50% of your benefits. And if you're over $44,000, you're looking at that 85% taxable mark. Now, don't let those numbers scare you into thinking retirement is impossible. This isn't about fear, it's about control. Just like the standard deduction helps people avoid capital gains taxes, knowing these thresholds helps you plan. Maybe it means you adjust how much you take out of your 401k next year, or perhaps you look into assets that provide more tax-free flexibility. You've worked too hard to let a hidden formula take away your peace of mind. Grab a calculator, find your number, and take back the steering wheel of your future. You've got this. If this helped clear the fog on your retirement plan, hit that subscribe button. We're breaking down the complex world of finance so you can build the life you deserve. See you.